Welcome into my Vanguard portfolio update. We'll jump straight into the updates on the markets because we've got a lot to get through on this episode. Just about trying to sneak it into the end of July, this one, to cover the whole month because so much has been happening. Firstly, the big news this month is actually the stock market, rather than having another all-time high, which is getting quite boring in these portfolio updates, actually has had a little bit of a wobble. Now, as you can see on screen now, the stock market, at least measured by the S&P 500 and other major indexes, had its worst day since December 2022. Now, an interesting part, not only did all of the big names fall, but lots of the smaller names as well. So it wasn't just something which was changed into one sector, and it wasn't just those big cap names which have a huge impact on all of the different indexes. I'll put this up on screen now, what it looks like in terms of the S&P 500 and the NASDAQ, as well as the Dow Jones indices over the past month. Now, you'll also see in those graphs that things have recovered since, and it wasn't actually as much of an impact as people thought it might be. There's always lots of doom mongers out there who, as soon as the market turns, expect it to go much further lower. Let me read you something quite interesting here from one of the news articles. All but one of the 11 sectors that comprise the S&P 500 traded lower, while 9 out of every 10 Dow members also saw losses. Even the small cap focused Russell 2000, which has run up amid expectations for forthcoming interest rate cuts, dropped about 1.9%. So this really was a market-wide dip, and there wasn't really anywhere to hide. Definitely let me know in the comment sections if you kind of managed to avoid this one, but we're all in this one together. Now, just trying to explain this, I think there's some different narratives going on. I'm always interested when you do look at the kind of financial news media. They always want to come up with a very simple explanation as to why the market went up or down. But I don't think life is that simple, because if it was that simple to explain the past, then you could also predict the future. And I think we've got some very strange ways about us as humans, how we think we can just explain things away, which are extremely complicated, yet we still want to have a very simple explanation for. I mean, for example, you can take the likes of Tesla, which just released its earnings, and they weren't particularly good. They were pretty poor, if anything, but the market had already expected that. Yet Tesla took an absolute beating on the day it released its earnings. However, since then, there's been quite a lot of comeback from them, and really it feels very much detached from what's going on in the company. Now, many companies also reflect this in the short term. The price, of course, can do anything. And one of the reasons, if you want to have a look at this, for example, not many people will know this, but Tesla is one of the most traded stocks on the stock market. So regardless of what goes on in the business, it's very favorable and very profitable for options traders and other people who want to do short-term trades. If you have a look here on screen, this is just as I'm recording this video, and it usually sits right at the top here, but it's the second most traded stock here on the stock market, with nearly $500 million worth of trades taking place on any given day. Now, just to put that in perspective, it's not like it is the largest stock in the market or whatever, or it wasn't necessarily that earnings took place on this day. It's just a very heavily traded stock, which of course explains a lot of its volatility, but always worth highlighting here. And just remember, there's so much going on under the surface that we can't really explain. Now, a second narrative, of course, lots of people on TV will say, well, there's some profit taking place because stocks have run up for such a long period of time. And that may also be the case as well, because the market has taken a bit of a dump there. So lots of people might be taking some profits off the table. There will be a huge number of people who invested in those big tech names and lots of other big names that have made a big profit over the past couple of years or so. Now, another narrative, you can see how these things layer on top of each other, was there is a little bit of a kind of rotation, this kind of big reset rotation, whatever you want to call it at the moment. Money moving out of those big tech names and those big players into these small cap stocks. Now, I'll put up on screen now an index of the Russell 2000, which is always a good one as a benchmark to kind of show us what's going on. Smaller companies, as many of you will know, actually over the very long period of time, if you can put them together and compare them against the S&P 500, for example, have actually tended to do pretty well, but only over very long time periods. In short time periods, as usual, anything can happen. And in most recent time periods, it's actually performed pretty poorly. However, if you have a look now at the index, at least over the past month, you can see the Russell 2000 has done pretty good at the moment. Now, the narrative behind this, as I mentioned in one of my other videos, is that investors are expecting rate cuts anytime soon this summer, and maybe a couple of different rate cuts from the Federal Reserve over in the US. Now, what this should mean is that the cost of capital, the cost of these loans, the cost of the debt, lots of these small companies should then come down, enabling them, in theory, to be able to grow quicker and faster. But until those rates happen, really it's just a guess, and lots of people trying to get ahead of that potentially, because in the short term at least, people think there's going to be more profit in those smaller companies. Love to also get your opinion on this one. Let me know. As someone who invests mostly in index funds, does have my own some individual stock picks, I'm always interested to see how long people would stay in this play, or if they would actually keep with this for the long term. Because like I said earlier, although small companies have tended to do very well, they only do well if you hold on to them for a very long time. So I'll be interested, if you do this play, are you a long-term investor as well? Okay, some of the tech earnings has taken place, but I'm right in the middle of the week as I record this. So I'm getting some of the earnings, but also looking forward to some of the bigger companies who play later on, especially the likes of Apple and Amazon are always very interesting ones to make. Lots of traders are going to be anxious seeing how those guys have done. Now, the reason, remember, why I think it's so important, and well, why they are important to the market, is those big tech names and those big names in the market make up such a huge percentage of the market itself. They play huge roles in the indexes, like the S&P 500 or your global index funds. So they really can move the market. The likes of Apple, Amazon, Meta, Nvidia, if they don't meet expectations, often people get concerned that if the big companies aren't making money, then the smaller ones won't have a chance either. Now, one of the big companies that has already reported earnings at the time I'm making this video is Alphabet, the parent company to Google, also owns YouTube and some other big names. Earnings were up 1.89 a share versus 1.84. Revenue was bigger than expected, 84.74 billion versus 84.19 expected. And also, the only kind of weakness, I guess, was that YouTube advertising revenue was down 8.66 billion versus 8.93 billion, which was expected. A big area, though, however, which lots of people do want to pay attention to is Google Cloud. Now, not lots of you, of course, will know Microsoft have Azure and Amazon have AWS. But Google Cloud is kind of this bit of this unsung hero, really, and it's been a big growth engine for Google. It has actually been a big losing part of their business, but recently has turned profitable. Now that, as you can see, has actually delivered more than was expected as well. And I think in the future, like many people, they expect this one to be one of the fastest growing parts of the business. And remember that cloud revenue, this income from different companies who use this service, is A, incredibly sticky, and B, incredibly profitable once you scale it out. So it'll be very interesting to watch this company as they go ahead through the years. I almost feel like I'm talking about my employer in a way, as someone who kind of makes their living through YouTube. I think really for this company, we're still very much early. Now, what was actually interesting though, is if you have a look on screen now, the kind of share price was sold off a bit during this kind of stock crash, even though the numbers were pretty good. So very different from the last few earnings where stock prices have moved up a huge amount. This one was a lot more muted. And even though the outlook is fairly positive, people just seemingly wanted to sell off. Another reason why you should never play anything in the short term and guess where the price of shares might go. Ultimately, who knows? Definitely seems like the AI boom may be cooling off a bit for the short term at least, but who knows? As I always say, we just don't know the future. Just jumping in here now, a day forward after recording that first part of the video, I really wanted to record a little bit more because so much I felt has already happened with a lot of the earnings going on, and I just wanted to jump in and share a couple of different updates. Now, lots of movements happened because a few different of the biggest companies in the world have reported their earnings, but also I just wanted to touch again on what I mentioned earlier about narratives and how the financial media will have to kind of explain a share price move. If a stock moves 10% down or up, there will have to be a simple explanation as to why that happened, as if it was obvious. Nvidia is a good example here. Haven't yet reported their earnings yet. As you can see here, there was quite a big drop, at least over the past couple of days, at one point down nearly 8%. However, if you look now, there's been quite a big recovery, and actually pre-market as I'm recording this video, the stock is recovering and is back over $109, which is quite interesting. Now, a lot of that potentially moving in sympathy with the other providers, especially Microsoft, who had a big dip. And let's just move on to them now. Microsoft, as you can see, had a relatively good earnings, but yes, there was some slippage in terms of cloud growth, not as much as expected, but generally a solid company, solid performance as always. Now, at one point, if you have a look here, they were down again, nearly 8%, yet in pre-market, they've recovered to the point where they're only down a couple of percent. And actually, they're kind of a bit of a trend line up. So as the market opens later today, potentially Microsoft ends up pretty much flat. However, if you look at some of the headlines, you'll see that it's as if, the game is up and everything's over for Microsoft and AI growth and cloud is over. And then just on a flip side, have a look here at AMD. Great earnings. And as you may expect from a normal perspective, share price up almost 10% here in the pre-market. Who knows what will happen when the market actually opens. But I did just want to highlight these, and we've got lots more coming, of course, just after I finish editing this video. We've got more earnings coming out. But I really did think it was interesting to highlight the narrative of what happens around big tech earnings. And then also, finally, something I didn't mention, two little stories here. I say little stories. I didn't even touch on the fact, you remember all the stuff that happened with CrowdStrike and Microsoft, that big update that caused all those huge IT tech failings. CrowdStrike having a very difficult time at the moment. In fact, if I just look at their share price, I didn't even realize CrowdStrike had plummeted this much, but over the last month, down 40%. That is just incredible. Some people thought that was going to be a very short dip indeed. Is that a buying opportunity? That is incredible now. From a company that was up at one point 60% for the year to date is now minus 5% year to date. That is just extraordinary. And the final thing to note, I did mention interest rates later on in this video, but the Fed is really expected over in the US this week to keep rates flat. There's a high probability that remains the same, but we might get some signals that rate cuts are on the way. Anyway, back to me yesterday in the video. Now, just putting all the big tech aside for a moment, one of the earnings I wanted to pay attention to outside of technology was McDonald's. And the reason I wanted to pay attention to this one was for a couple of reasons, but let me just go through at the moment. So they saw their first global sales drop since 2020, and their share price kind of took a bit of a beating, but it has recovered at least since that's been posted, because the company has now come out and really said they're kind of looking at their pricing once again to see if they can attract more customers. A couple of notes from the chief exec. They reckon consumers were more discriminating with their spend. Now, they also said that you're seeing that the consumer is eating at home more often, and you're seeing more deal seeking. Now, I don't know about you, I'm not necessarily so sure on this one. I think the likes of takeaway food and generally eating out of the house, I think is such a competitive business, whether that's here in the UK or over in the US. You have every kind of name under the sun. And I don't think every single restaurant business or every single takeaway business or fast food business is experiencing the same pressures. Now, for example, if I kind of compare this to a brand in the US, especially, who is doing really well at the moment, a brand like Chipotle, you can have a look at their earnings. Total revenue increased 18.2%, restaurant sales increased 11.1%, and operating margin was 19.7%. And that's quite a premium high-end brand. If you've ever been over to the US and have a look at Chipotle, you can easily spend quite a lot of money if you put a big burrito together with some chips and a drink as well. So I'm not necessarily so sure that I buy this, that the consumer is kind of cutting back and is too price sensitive. I just do think that there's so much choice out there, and love them or hate them. I mean, I haven't had McDonald's for a very, very long time, but that's just me. I think there's just so much more competition and choice out there. So I'm not sure if people are just staying at home because of that. And just quickly, let me touch on another thing, which actually is going to tie into another topic I wanted to talk about. So one thing they mentioned is pricing. Now, what's quite interesting is the Big Mac has risen 27% in price since 2019. And that sounds like a lot of money, because kind of any normal time, that would be quite a lot of money. However, if you actually go back and look at what has kind of been the real effects of inflation in the US and the UK, let me just show you this now. So if I go over to Trueflation, quite a good little data source here, the aggregate number of inflation since 2020 to right now is 25% over in the US. So therefore, the Big Mac, in theory, hasn't really risen at all. It's kind of just gone up in line with inflation. And actually, it's a very similar thing here in the UK. So let me just put the UK numbers. Unfortunately, we are a lot worse. But again, since January 2020, our aggregate rate of inflation, all of those different years kind of compound and add up, is 37%, as you can see here. Now, that's an enormous amount of money. And of course, that's just the average of everything put together in different weightings. Many areas have gone up more, some areas have gone up less. And your personal rate of inflation as a consumer is going to differ massively depending on where you spend your money. Often as well, you'll hear that kind of the poorer in society often have inflation affect them more because, for example, if food goes up 50% and you spend most of your money on food, then you are going to experience a bigger amount of inflation. And I think this is probably what annoys a lot of people as well when they see the figures coming out from the ONS and the government taking credit for inflation dropping. Often people are annoyed because the numbers don't reflect what's going on in their lives. But we do need some place to start, if that makes sense. But anyway, the point I wanted to make in this one was that actually the price of McDonald's, at least on the Big Mac index, hasn't necessarily gone up. It's just stayed in line with inflation. So some people, if they've been given pay rises in line with inflation, things have they cost the same in real terms, but other people might be looking at the nominal numbers and just saying, oh, wow, this is too expensive. So it really depends where you're coming from. If you've been given pay rises in line with inflation, and there are plenty of industries who've had that, then you're doing okay and the price is the same. But if you've been kind of left behind, then I can see why the likes of McDonald's is going to be appearing more expensive. And I think that's a similar story here in the UK as well, which I wanted to touch on in a moment, just before I look at just some of the couple of things going on with the Bank of England and interest rates here. But I think generally we forget about inflation when we're talking about price rises, and lots of people want to talk about bills going up. But take council tax as a good example. I mean, you probably would have had yours come through the post at least a few months back. But I remember when I got mine through, and I think the increase was something like 4%, maybe 4.5%. But if you actually remove inflation, it's only a very small amount on top of inflation. So it's not like it has increased by 4.5%. In real terms, it would have increased by like 1%. So lots of people will look at that and say, well, I haven't got 5% better services in my area. Why is council tax constantly going up? But it isn't necessarily going up in real terms. And we need to kind of reflect back and remember that prices need to be taken into account with inflation. And this applies to so many different numbers we see in the financial world. And I think we need to kind of focus on this a little bit more. But do let me know your opinion on this one in the comments section, because I think it's weird. If a price stayed the same from this year to the next year, technically that means it's gone down. Inflation adjusted, it's gone down. So I wouldn't expect any bill to ever remain the same, because that would mean it's gone down. Likewise, if you're being paid the same this year as you were last year or the year before that, you are losing money. So please be aware of that. Although it might sound simple, and many of you'll think I'm teaching you how to suck eggs, but I don't know if everyone is truly aware of that. If your wage stays the same every year, you are getting a pay cut. And well, I don't have to tell people in the public sector that, but anyway, always worth knowing. Now, going over to the UK, you can have FTSE 100 here, up about 1.5% as recording this video. As always, things will change as soon as I edit this one, so I'll whip up the latest thing on screen now. Doing pretty well, I guess, compared to the month. And we're also kind of battling interest rates here in the UK. The FTC is saying that the Bank of England rate decision is on a knife edge as UK inflation sees overall rate sit down at 2%. Having a look now at the different numbers that make up the inflation in the UK, it's quite an interesting story. As you can see, that services inflation is really staying sticky, and we're a services-led economy. Lots of that is because people have been getting those pay rises to keep up with the effects of inflation. However, not everything has actually gone up. If you have a look here on this chart, you can see that the goods prices, that's kind of definitely across different things you buy in the shops, some of them have actually been going down. So they've actually been deflating in price, quite interestingly. And then the average, of course, which the rate of inflation, which all the newspapers will talk about, is on that 2% rate. Now, this is the kind of target rate that the Bank of England want, and they've got a very careful balancing act, of course, to manage those prices and to make sure that they don't slip the UK into a recession for the second time, but a proper recession. So they're going to have to act at some point, probably taking a steer from the US. Whether they make their first cut now or not from 5.25 to 5% will be quite interesting, because if they react too early or if they react too late, then they're going to either remain the fact that inflation will keep going higher, or they will potentially crash the economy or at least slow it down. It's an impossible job, to be honest. I definitely would not want to be in that position. It is worth saying that the only kind of main economy who has taken an early step I did see was Canada. If you have a look here, they reduced their rates down to 4.5% last week. So I would expect us to move in a set with the US at some point, but it's not out of the realms of possibility that we see UK interest rates go down to 5%. And this will have a huge impact if you are looking to remortgage or looking to take a loan out for any kind of big purchases as we go down over the next few years. Not to forget as well, of course, that interest rates set by the Bank of England will also have a major effect on the cost of borrowing for the new UK government. So the lower those interest rates, the more and the lower the cost of that capital is for the government to actually borrow and put into investing and trying to get the growth that they want. Lots of stuff announced, as you would have seen, by Rachel Reeves yesterday as I'm recording this video. New fiscal black holes, lots of cuts taking place, and it's going to be very, very interesting to see what they do moving forward. I'll cover more of that if there's any effects on, specifically from an investing standpoint. I do think that the next financial year, the next proper budget, will be very interesting, and I'll keep everyone updated. My video on kind of ISA changes and the British ISA has done crazy numbers here on YouTube. You may have seen that one already, but feel free to take a look at that one afterwards. I think the new financial year could be very interesting if they make any big changes, because no doubt I think something like dividend tax and capital gains tax, which does affect a small number of people but affects them in a big way, could certainly be something which they target, but we'll keep an eye on that one. Now, with the markets all out of the way, what about the actual portfolio itself? So let's have a look how we're doing. Now, as a quick recap for everyone, whether you're new or you've seen this a couple of times, this is now just really my pension investments here on the Vanguard UK platform. So you can see a total amount here of £52,978. Strangely enough, I do have a small amount of money left in my old ISA here. I did message Vanguard on their platform and I said, oh, can you transfer that to my Trading 212 ISA? And they did say they were going to do that. So I'm expecting that to come across at any point, because it is weird at the moment. As you can see here, it's almost got the total gains are still left on that ISA account. So it might look weird how you've got money there, but only £12 in the account. And that's the reason why I moved my ISA. I should say I moved my ISA to InvestEngine, forgive me, but I do have another stocks and shares ISA over on Trading 212. So I've got my Trading 212 ISA, I've got my InvestEngine ISA and a small SIP over there as well. And then my biggest SIP is over on this Vanguard platform, as you're having a look now. As many of you will know as well, I keep things very simple. And my plan at the moment with this, which really hasn't had a huge amount of money go in over the past year, I am now contributing, at least I have done for the last several months, money from my company into this pension, because I do want to make sure I make the most of pensions and ISAs, really. Those are the two most important investing accounts you have in the UK. So at the moment, I'm trying to put in £500 every single month, which I'm just doing manually at the moment, from my company, contributing that into my Vanguard SIP. Now, because I'm a director of a limited company, that actually is an allowable expense, which I've mentioned before. So it means, for example, that rather than that £500 having corporation tax on it, and then if you pay yourself as dividends, for example, taking that out, it can go straight into your pension, and that won't have to be paid any corporation tax or dividend tax on it. So I'm trying to do that one at the moment. Maybe I'd like to contribute a bit more as well. Always trying to balance that pension with ISA. Now, I did a video, which you may have seen recently, covering pensions, because I think they are truly one of the most powerful investment tools that you can actually use. But really, when I did that video, I'm more talking about workplace pensions, especially if you're employed. I'm only saying this because I'm employing myself as a company director, so I don't have any pension that's being paid into for me by my employer, because I'm my own employer. So this is what I'm kind of doing to counteract that. But if you are employed, certainly in my own personal opinion, as a non-financial advisor, obviously, I truly do think it's worth at least, maxing out those contributions and making sure that you can get that employer match from your employer. But I'm not going to go into too much more details on that one. Please do see that video that I did on pensions. I do think it's pretty important, and it's probably one of the least known, and at least, it's a complex area, pensions, at the end of the day. So make sure you try and understand it as best you can, because even if you never invest another single penny and you never invest anything inside an ISA, for example, I do think that ultimately we're all investors through pensions. And if we can understand them a little bit more, we can get some huge returns, and we don't really have to touch them for a long time anyway. Now, just on a final note, as many of you know, I keep things super simple in this account, keeping my fees nice and low. I just invest in the FTSE Global All Cap Fund, which is an accumulation version of this mutual fund. You can see here kind of how the price has gone up over time. This one invests in all kinds of different companies around the world, including the kind of smaller companies as well, which I will hopefully benefit from as we move forward. The reason for this is just, like I said, is to keep things super, super simple. I don't want a complicated portfolio here of lots of different funds. I just want to buy the world and its market cap weights and dollar cost average investing regularly. And for someone who wants to do that and build up wealth over a long period of time, in my view, that's one of the most important ways and all you can really do as an investor. So I keep things super simple. There's no dividends being paid. It's the accumulation version. So any dividends that do get paid from the companies remain in the fund, and they'll benefit the fund moving forward. So more of those dividends will buy those shares. There are loads of different funds you can buy on the Vanguard platform. I've done different videos on that one. And really, it's up to you how you want to do that. I definitely have a preference to be a global investor rather than just the S&P 500. That doesn't mean the S&P 500 won't do probably very well. Ultimately, the S&P 500 will need to do well if this does well. I own all of the same companies in a global index fund as is in the S&P 500. Remember, the key difference is when you're looking at the S&P 500 versus the world or something like that is really It's just the weightings. So I say this a lot of the time when I am on kind of one-to-one calls with people, but people often think, well, what's the difference between the world and the S&P 500? And remember, it's the exact same companies. It's just how much weight. And if you want to describe it like food, it's the same ingredients, but there's just more of said ingredients in the different funds. But that's kind of on a simple basis anyway. Now, remember, if you want to get yourself started with any kind of stocks and shares ISA or an investing account, do check the links in the description. You can open up different accounts, get yourself some free shares or some free cash just to get started. Check those out below. Make sure you are subscribed. If you haven't already, please like the video on the way out and let me know in the comment section below how you're getting on this month. I'll see you in the next video. Happy investing.